Welcome to the Month End CPG Community Chat. The Month End will provide emerging CPG brands real-life knowledge into the accounting, finance, and operational worlds. Our guests will be key stakeholders from those same brands as well as other key contributors in the industry. All right. Welcome to episode 30 of the Month End Podcast. We have Keith Kohler, your financing man, back from the prior episode to chat more information on kind of action items and next steps on the debt financing topics we talked about in episode 29. Hey, Keith, long time no talk.
I know, Brad, it's been so long.
Hey, at least we have different shirts on. It's a different day of the week for everybody out there.
We do.
All right. Well, we're looking forward to get going. So I think first things first, for the listeners out there that are listening to this, stop, pause, go back, listen to episode 29. That'll kind of get you kind of set up and understanding the types of business entities, the types of financing we discussed. It's about an hour long. It's super informational. It's great. Please listen to that, then come back to this. But before we get started, again, Keith, kind of just give a little more background, reintroduce yourself to the audience, and then we'll kind of, moving into summarizing kind of a previous podcast, a recording of kind of types of entities and things we talked about. Then we'll get into the bulk of this conversation. So go ahead.
Yeah, my pleasure. So thanks again, Brad. It's great to be here with you and to be in support of the larger Accountfully community. And as a reminder of introduction, the way I support founders at different stages of their development, from startup through to lower middle market, is I help them essentially get the right financing at the right time, advise them on what could be available to them at different stages of their company's growth, and then help them go get those deals, whether through referral or by actively participating in the process. And my overall most important promise to everyone out there is that I can meet you where you are and guide you along your financing journey. And meeting you where you are means whether your experience in finance is small or beginning, or whether it's super advanced. There's a way I can help you make sure that you're getting exactly what you need at the right time. And we also recognize that your journey might not just be the one on getting financing. There could be other ways to support you, which is with your mindset or other elements that contribute to how you show up in managing your business finances, or how you might be best suited to go after a financing process. By way of additional background, I'm an advisor to many companies in the CPG space, and I'm also a seed and an angel investor in several as well. And the way I got my start in this business was when I was diagnosed celiac or gluten intolerant in 2005. That gave me my first real big reason why, and important introduction. So it's personal to me. I want to make sure that this space does well, gets the best available financing for their businesses to fuel their growth and meet their professional and their personal objectives. So that's essentially me and what I stand for. And I'm really excited about today's topic, Brad, because I think you probably see it all the time. I imagine you're asked to support people on financing requests a lot, right?
Absolutely. And I think, if you get one takeaway from this, listeners, it is be proactive. Don't wait the last minute. I don't know how many times somebody comes to us. All right, now I'm going to sign with you Accountfully to get going. I need my books tomorrow. I need a 5-year financial model tomorrow. That's not how a society works. That's not how a good service provider works. That's not how a good relationship works. That's not how you're going to really be able to secure what you need, when you need it. So, but yes, we're constantly inundated with those requests and support, and clearly we'd love to help that and get it. But I think having a really good comprehensive plan and approach helps out with that, with the listeners and the brands out there.
Yeah, and Brad, you and I have the same experience. When people come to me for financing, probably about 2/3 of the time it's, oh shit, I'm in a pickle, right? I'm stuck. I didn't plan for this, or really, and some of it we know was systemic, right? It was supply chain crises. It was now banking crises. Some things that were surely out of the control of many of our founders. And yet, even before that, it was still the majority of people who had not planned for it. It's rare the occasion that I get, hey, I really want to be thoughtful about what my financing options could be open to me because I think I'm planning this growth. I'm not sure. And what can we figure out? It's an extremely rare circumstance. And yet that's still the way I like to guide my discussions, that even if they're not asking about it, I like to make them understand what could be possible. Yeah. And yet there is a middle ground where people do come to me with a very specific need. I want to buy a piece of property, right? I want to buy equipment to put in my co-packer because that'll help me with my efficiencies and include my gross margins. I'm hiring people. I want to get financing to support the working capital or other requirements. So I think there has been, as a result of the pandemic and a result of the supply chain crisis, more founders are more engaged with their finances and understanding happily at least more of the day-to-day. And I think with that baseline, there's a lot more ability for them to grasp quickly and understand what financing could mean and how it will support their growth.
100%. I think two big things that I see of reasons why people are more proactive. Number one is if you've done this before, if you sold a company, if you've been involved with a startup or a different business or whatever, a lot of those folks literally come to the table right at the start of their next venture. Hey, I want to get a good set of books in order, a good team. I know this is important. Let's go from the start and let's move on from there. And then secondly, looking at what happened the last 3, 4, 5 years, right? The pandemic, boom, like everything's stopping. What's going on? Changing the way we live, changing the way consumers buy products. Number one. Number two, the supply chain issue as a result of that. Like, getting products in, understanding cash outlays, things like that. And number three, just most recently, the banking crisis with SVB and things like that. Just the whole point of those three situations are, like, now more than ever, if you're not like aware that something could happen tomorrow that can impact everything, that then you may need to have your tax returns done, your financials done in order to get a loan tomorrow, like PPP, when all that came out from the COVID situation, then I don't know what else to tell you. Society changes so fast these days. Who knows what's going to happen next week? So, at the end of the day, basically get your shit in order now, and then that'll help you long term as we go forward. So that's just kind of I think the big I think theme from both of us is just be proactive at the end of the day, and then we'll get
proactive. And yet we recognize it's one of the hardest times ever to launch, grow, and succeed in CPG, because there is so much stuff that's extraneous and macro and out of our immediate control. And yet that reinforces why we must be always prepared, show up the best we can, make this a priority in our businesses, engage actively with us, trust our leadership, right?
Yep.
And let us help guide you the best way we know how, so that you have the best chance of having a successful outcome.
Yes. Good. Well, let's get into some specifics, Keith. So I think like action items from, specific or tangible action items for kind of the small business owner, right, to help prepare for it, as well as then. So let's go to action items right now, and then we'll get into kind of specifics of requirements maybe that are, that people will need when they go to underwriting. Like, this is going to be asked, so make sure you have this under. So number one, just kind of basic, tangible 3 to 5 action items. So let's start with that.
Sure. So again, we'll get to the documents afterwards, right? And talk about
exactly.
And first, talking about really, how do you get prepared, right? How do you really start this types of process? And I think even beyond being committed to whoever you're working with, right? I'll start with your finance team. I think that's the most important thing to be considering is when you're working with Accountfully, when you're working perhaps with me on financing, when you might be working internally with people, do you have everything you need to be set up for success, right? And not just do you have the team capabilities and the skill sets, but are you really committed? Are you committed to managing your finances actively? And really what I mean by that is what I call getting into a finance rhythm. And I wonder, Brad, right? Probably all your clients have a monthly financing call with you or have the option. Are there any of them that don't do it?
Yeah, there's some that don't do it for multitude of reasons. I think we basically kind of push or require people to do it. I think it's a super value add as much as possible. There are some people that are kind of lower budget, more bookkeeping clients, but the ones that are kind of at this phase, CPG growth, I think that financial report review call really helps them understand their business, their margins, KPIs, looking backwards the last month, last quarter, last quarter versus the same quarter last year. That type of stuff I think really helps them understand it, and at the end of the day, it kind of subconsciously starts putting that in their head and brain, which helps out when you deal with investors or possible investors and things like that.
100%. And I think one of the things we get to do as service providers and advisors is step up in our strategic support, right? The way we see things beyond the numbers, how we can help the founders make good decisions and how we can support them in financing processes. So I really think of our role as an extension of the core financing team is now more important than ever. And the importance is engaging with us, right? Communicating with us, telling us your needs and keeping us top of mind and, well, dare I say, on speed dial.
Yep.
So
So
I really
number
can't-
one, having your financing team or your kind of financial and finance team in place. Number two,
the alignment on the strategic objectives you wish to have what you wish to achieve in a financing process or in your growth, being truly aligned. A very classic example is I'll often see a founder saying, hey, I'm still all about growth. And yet, what do they tell their tax preparer? Well, I don't want to pay any taxes. Right? And then you get this quandary of how can you support growth if you're not going to even report what you're really making, or even maximize your opportunities by what showing a lot of profitability can do for you. So I still find that there's often misalignments by even founders going to war with themselves about what they might want to achieve versus the way they historically have done things, particularly if for the first time they're experiencing growth or they see good opportunities. And I also see misalignment even internally on finance teams, right? Sometimes I think, Brad, you might choose to account for someone on a more conservative basis. Sometimes it's more aggressive, and we get to dance and make choices there. And I wonder how many times the founders are really saying, hey, I need to be more engaged with this and be thoughtful about what I'm really trying to achieve. And the last thing I'll say on alignment is family alignment is a big thing. The pandemic was rough on so many families. And if you're a founder out there that has a spouse, a partner, an important significant other, and or a family, what you're thinking about financing and your preparation and your mindset could be different, a lot more different now than it was pre-pandemic.
Gotcha. Perfect. Finance team in place, alignment. What's another one?
Yeah, mindset. Really quickly on that. Mindset is a big issue in its own. And the key thing there is we live along a continuum of scarcity and abundance. And sometimes there are days when we feel incredibly scarce, things outside of our control. We can't get our product, our co-man's not replying to us. I'm not getting paid by my customers. That can toss you into a really bad mindset, generally called scarcity. And yet, if you can see a longer term, so yeah, manage your day-to-day actively. I really want you to be focused on cash and all those key important KPIs driving your business. And yet, if there is a way for you to continue to have a long-term vision, and long-term can be 6 months, it can be 12 months, whatever that bite-sized piece is that's right for you, I think you have your best chance of stepping into an abundant mindset. And if you've done the work, if you're supported by Brad and his team, and then someone like me or others helping you, you're more likely to be there. So with your mindset, finance team alignment, and then your physical energy, realizing any financing process takes time, you need to show up in your best, and you need to be available to respond. Nothing kills a deal process like time creep and not responding or communicating on a timely basis. And when you're working with Brad and his team, I know you're going to get the data quickly. The question is, how do you really massage it and use it to keep pushing you along in any type of either equity or debt financing process? So those are the key things there.
Love it. Financing team, alignment, mindset. Next one.
Well, yeah, energy and availability.
Energy availability. Perfect.
Yeah. So that's what I've got for them there.
So then I think the last one I would say, from outside of us getting actually into the documents and financials and requirements, I think for me is, this is like anybody for, networking, relationships, right? Like,
oh, absolutely.
Always be shaking hands, always be connecting with people. You don't know who will refer you to clearly the next business, the next vendor, the next person that could be your investor or whatever. So just clearly as an entrepreneur, business owner, understanding that, networking doesn't need just to be with growing sales and customers. It's also financing, networking, right? Like local banks, small banks, getting involved with those. Some brands we've dealt with in the past, basically we're able to get SBA banking loans kind of much earlier in the process than they ever would have, from what I typically see, because they created a relationship with a small, medium-sized bank and kept bugging them and kept dealing stuff. And over time, they saw some improvement and underwriting approved them, which is great for them. So relationships. So
yeah, and I'll just add one sentence to that, which you highlighted, is oftentimes I think a lot of us as founders and sometimes service providers and settings one sentence we can use to end a conversation is, and Brad, hey, if this is not something you can do, where are some other places I could go? That question can change the direction of your business fundamentally. I've become aware of more financing sources because I'm more actively asking that, particularly in the fintech space, which is ever evolving, it's expanding, contracting, and everything. So please, yeah, indeed, ask that question. If this is not for you, where else could I go? And 9 times out of 10, you're going to get a good recommendation.
Yep. Awesome. All right. That's some great kind of action steps, intangible types things. So let's get into kind of, what is required from a documentation standpoint on the loan application process for most of these, types of debt financing loans we've discussed.
Yeah, perfect. So let's, the way I like to do it with customers is I do it in 2 phases. I start with a really core set that can be applicable for anything or nearly anything. And then I go 1 layer deeper because a key thing is most people don't like to prepare documents and they don't like to fill out paperwork. So I try to make it as painless as possible to do the least amount of work to go to the most amount of financing sources available. And then when I identify what most makes sense, then I'll go 1 layer deeper. And so what does the core set look like for most of us? So right now we're recording this in April 2023. It's a super interesting time of year to be doing this recording. So I wonder, Brad, when you think of your clients, how many of them have filed their 22 tax return? Like what percentage? They're corporate.
Probably a third.
Okay, probably a third. Let's just talk about that one for a second. So almost all financing sources, well, all the term loans, all the SBA loans, sometimes in other working capitals, they might ask for tax returns for information purposes. We all get to make choices. I was that guy on extensions for several years. It's kind of what I learned and it's what I knew. Now I'm more faithful about filing at the first deadline. Here's my recommendation. If you had a better year in 22 than you did in 21, it's always a great idea to file as soon as possible. It's always a great idea. Now, you might not like it because you might have to pay more taxes and you want to do that. And yet, if it was a better year than last year, it's going to open up your financing options more broadly, and particularly if you're profitable. It's always good to file taxes at the regular deadline if you're profitable for the first year in 2022. And a lot of you probably were. You might have had a banging 2019 if you've been around for a minute, and then 20 and 21, you were in the red for all the reasons we might know. But if 22 was your true recovery year and it's profitable, if you haven't filed your taxes, I really encourage you to do it because more opens up for you, particularly in the SBA and other loan areas. So the first document is the tax return. So lenders, banks, and SBA lenders are going to look at 3 years, whatever the 3 most available are. So if you filed 22, it's 22, 21, 20. If not, it's 21, 20, 19. And then in lieu of tax returns, they're going to ask for year-end 22 financials.
Gotcha.
So
that's what I was going to ask.
If you haven't filed your tax return and you don't have 22 sewed up and buttoned up, which I can imagine only a couple of people, if any, then that would be problematic for you to move ahead. So tax returns, that's the first thing, corporate. Just to quickly mention personal tax returns, those do have a play in lending, not so much in the working capital space, in fact, hardly ever. And yet, if you filed your corporate on the March 15th, go ahead and do personal April 15th on the assumption that you can afford to pay if you have to pay something additional. Personal, less important in overall. The corporate are really the key ones. So that's where it is on tax returns. In some rare cases, Brad, if you have some larger clients that are 10 million plus or so, banks or others will look at prepared financial statements being more important than tax returns. So if you are in that category or you're coming up to be there, 10 million plus, something to keep in mind and worth spending the extra money because the lenders will want to see that level of detail.
Cool.
Yeah, so that's everything in the tax return bucket. Again, here we are in April. So now we're far enough in 2023 that everyone asks for interim financial statements. And usually that operates in a 90 to 120 day window, sometimes a more compressed time frame. So we've now passed over 90 days into 2023. So again, bank loan lenders, again, these are the highest amount of document requirements, right? SBA and commercial lenders. So they're going to ask for year-to-date financial statements. So particularly in this time of year, now more than ever, being engaged with Brad and his team and having that monthly call, being aware of how was January, how was February, really, really super critical. One little pro tip, if it's a weak quarter for you versus the rest of the year, something to, before you send in those documents, educate your finance source about why it is and how it is. And one way to overcome that and to make it less of an issue for you is to compare it in the similar period last year. So if you have January, February, March 23, and it's higher revenue and higher income or a lower loss than January, February, March 22, even if it's not enough to afford something, it's still something you'd want as part of a package, because it will be asked for if it looks relatively weak compared to what a full year has historically looked like for you.
Yeah, and I just think on top of that, comparing, right? So as this comes to the education of your financial reports, of your tax returns, of when you're profitable now, but always when you're looking at different reporting periods, right? Understanding, wow, I killed Q1 was down, or it was lower than my forecast, but I was 300% up from last Q1.
That's right.
Right? That's a story to tell.
Right? It is a story to tell.
And then, hey, I have this, plus I have POs and things coming in, plus we're doing this the upcoming quarter. So when you create the relationship, you have those conversations, guys, here's this, we went above this, our Q2 is going to be like this, or Q3, so that gets the attention of people, right? And then that's the big thing. So understanding a story, this is storytelling as well. This is just as much of storytelling and nuance and art than it is pure science and numbers.
Brett, I can't agree with you more. And that's often a missed opportunity. A lot of people will let an outside funder plug into their QBO, which is required mainly for fintechs, right? And yet our big opportunity is to control them. Now, dare I say control, but have an outsized influence on the narrative, particularly if there's something that someone could say, what's that? Like if you had a rotten Q1 just because you did a huge marketing initiative that fell flat, and you're never, ever going to repeat that again. And it's like, what was I thinking? I hired some influencer and it just didn't work out. Well, that's a one-time expense. And that should be portrayed as a one-time expense and say, hey, I'm never doing that again. Another example is you hired the most amazing VP of sales and he or she did not work out. And you're never going to do that again. You're going to handle it on your own. That's another thing that could be added back and needs to be discussed. So really, please, I invite all of you, never just submit your numbers. Take some time and write a thoughtful narrative that says, here's kind of write the key to the treasure map, right? This is the guide saying, here's the way you could look at these numbers to determine my strengths or not, right? For this type of financing. And yet we know underwriters are human. They're going to make mistakes. Business development offers can make mistakes in looking at files. So to the degree you're presenting your best face forward, let's just like a college application essay. And really highlighting the most important things and mitigating what could be construed as either weak or not serving your interest on getting what you need. So that's really a critical thing. And that write-up can make the difference between a yes and a no or a not now.
So tax returns, interim financials, most recent period. What else?
In some cases, your personal credit score. And the way you can do that is you don't have to pay for it. You can go on Credit Karma, Credit Sesame, places like that. We know that they're not perfect, but they're pretty indicative. When you do a self pull of your credit score, if there's stuff that needs to be cleaned up or stuff that requires an explanation. So I wouldn't look at not just at this. Well, if it's a score above 700, looking just at the score, you're in the clear, nothing to worry about. If it's sub 700 for any reason, and you can trace as to why it is, hey, I just had to use a lot of credit cards to finance my business. Or, hey, I took my eye off the ball at the holiday time. I have a 30-day late in December. That tossed me down. Get ahead of that explanation too, right? And usually that person who explains it first versus them asking you, it always is a better look. So the self-pull of the credit report and understanding if there's an issue to be addressed and having a proper explanation about it is a great way to get prepared too, because no one likes surprises. Mm-hmm. Another key thing is everyone's going to do a background check. And Brad, this came up now even more because of the fraud that was committed in the PPP and EIDL loans.
Yeah.
Particularly in the SBA world, but all around, I see more and more providers doing background checks. So I think you can go to different sites, like, was it like reputation.com or something like that?
Oh my goodness, no.
Yeah, if you have anything in your past, anything that could cause an issue either because of a crime or some type of, whether people who've had felony convictions can still get financing. And usually it's about getting out ahead of it. Everything counts, even things like speeding tickets, DUIs can be an issue. As long as you get out in front of it, talk about, hey, this did happen, and yet that's not who I am today. That's really a thoughtful way to control that. And oftentimes people overlook that, and surprises can come up in underwriting because background checks aren't pulled till way down in the process.
Mhm.
And no one wants to do all that work and not have a successful result. So a couple of other last things, depending upon the type of financing you're going for, a lot of working capital you might get with your receivables and inventory. So really looking at your AR aging, typical schedule in the AR detail. Some people ask for detail, some people just ask for the aging report, and then really an inventory detail as well. Those are reports probably people inventory, they very rarely review it, right? I'm sure you get very few requests on that. I think more people could pay more attention to it for proper management. So that's going to be for a lot of your working capital and fintech ones that are looking at that. And then sometimes for other types of specialty financing, it could be purchase orders, etc. And a final key area is if you're asking for refinancings or, if asking for refinancing of debt, that's often a use case of term loans or SBA loans, having those original notes.
Gotcha. And then what about forecast budgets, models?
Absolutely. Thank you. So when you think of banks, most banks and institutions are backward looking. They're looking at historical documents, what you've done to date. Most fintech and working capital providers are forward looking because they're looking what can you do in the future. So it's often the case that forecasts are done and they're never looked at again, right? I was wondering, Brad, do you, when you update forecasts, do you do it on the request of the client, or is that an annual process for you?
We basically have a custom scope of work for every situation, right? Some people just want us to do it at once, not update it when they wanted to, just to save on money. I think the best case scenario though is that we put together a 12 and 18 month budget / forecast, update it each month, have it rolling, compare it to where it was, make sure it reconciles to the chart of accounts, so then we can look at target and budget, target to budget, or budget actual as well each month. So I think at a minimum, if you really want to get ahead of it, I think getting one in place and then updating it quarterly. And again, having it rolling 12 or 18 months is probably the minimum to where you're at. But again, I think getting in place, having a team that understands your chart of accounts, your books, having your forecast / budget / model tied to the chart of accounts so you can easily compare budget to actuals. Those practices are going to help you tremendously as a business owner going forward. Whereas some folks come in, give you a model, charge you 10 grand for 5-year model, help you raise money, doesn't align with anything, super complex, 28 tabs of Excel. Nobody knows how to do it. This person's gone. Formulas galore. Comes to us, we're like, this is way too complex to simplify. I think a big part of this is try to keep it as simple as possible. I
totally advocate for that. In fact, I think there's really two forecasts, right? There's the internal detailed model, which helps you for your operating and your management decision making. And there's an external summary, which is really all you need to get that ball rolling. They'll ask for more if they need it. Outside of the equity world and the debt financing, rarely they care more than just a thoughtfully produced summary P&L and a summary balance sheet. Usually it's not crazy detail that's needed. So again, you might want to have an internal and external. I totally advocate what you're saying about quarterly updates at a minimum, specifically for all of you out there who are on a high growth trajectory. And I'll add just one thing, or as major conditions change, right? If you have a pivot, if you've launched an amazing new product, if you've just gotten into a trade account with a ton of doors, which is going to double, really important to support getting that new forecast in place.
If you hired a very expensive internal hire, things like that, any kind of material dollar changes, I agree with Keith, like that materially impacts your your budget updated. So good.
Yeah.
All right. So is there anything else here? Because I wanted to touch on some kind of just general kind of accounting, financial statement kind of, mistakes and
Oh, yeah,
errors.
please, that's good. Let's move into that. That's pretty much the core big set out there. And just know that most people are going to want to understand projections. They're going to focus on the next 12 months more than anything.
Yep, exactly.
Yeah.
And what's great about like what you're saying about the requirements, literally, if you work with somebody like Accountfully or an accounting team or have a proactive situation, every one of these reports are easy to pull. Clearly, separately, your credit report, separately, your individual tax return, those types of things. But everything else, we can pull some, all these reports for a client within 15 minutes. And that's what's great when you are proactive and have things in place and are set yourself up mentally for that.
That's when your investment really pays off, doesn't it? Because having these at your fingertips and ready to be used. Yeah. Because having them accurate and timely is the most important thing.
Yep. All right. So from a kind of financial statement perspective, pure, like if you sent your financials, your P&L over to Keith or any kind of, underwriter to look at, kind of several things to be kind of aware of. Number one is, I'll just say kind of incomplete financials. What does that mean? That basically means that not all the data is contained in there. Like, what are examples of that? Number one is you don't have all your bank accounts on your balance sheet. You don't have all your credit cards on your balance sheet. You don't have all the transactions up to date through the most recent month and reconciled. You may have skipped 6 months. All basic things that a professional bookkeeper accounting firm should do for you, right? So number one is just having complete financials reconciled to the most recent quarter or month or whatever they need, and make sure that all the assets, all the liabilities, the completeness, accuracy is there for your business. Number two is cash versus accrual.
Oh God.
What does this mean? Cash basis accounting is essentially whenever a money comes in or money comes out, you basically put it on your P&L or your balance sheet, right? The only transactions are when things move in and move out, or a credit card charge happens, or things like that. Accrual based really factors in kind of two big things, right? Accounts receivable and accounts payable. You invoice KE for 100 grand, you put 100 grand on your receivables, right? Your revenue goes up by 100 grand, your AR goes up by 100 grand. That wouldn't be on your P&L or balance sheet during when it's cash based until you actually get paid, right? Same thing on the payables. You get a bill for accounting, for legal, for 3PL or whatever, that needs to be factored into your financials. What people are going to want to see is accrual basis. Why? Several reasons. Number one, it is a complete view of everything that you've incurred and earned to date, right? It shows what's going on a revenue basis. What do you have to collect? Like you said, AR financing, right? What bills have you incurred? What is your liability on those bills? What's your credit card balance? All that type of stuff that kind of comes into play. Number two, and almost more importantly, is you're able to kind of compare month over month in terms of, what is your fixed overhead each month? What is your margins each month? That type of stuff, right? Like a big time when people come to Accountfully or talked about is when they're like, my bookkeeper doesn't know how to account for inventory and COGS. I pay 20 grand or 50 grand for inventory. That outflow goes right to the P&L in COGS. And then my next outflow is 4 months later. So you don't have any consistent way of looking at your margins month over month, right? Your COGS should basically be factored into what was sold that month. So a big part of this is moving into accrual basis financials for your business from a financial reporting standpoint. FYI, that needs to be done. You can still have a tax return on cash basis if that's what your tax CPA requires of you or allows you to do. Just an FYI, it doesn't need to be the same thing, but for internal management reporting purposes, you need to go to accrual basis. So if you're on cash, if you're looking at raising money the next 12 months, you got to move to accrual at some point, like in the near term.
Yeah, and I really feel strongly about that too, Brad. I have a question for you though. How frequently do you have accrual financials for a company that show profitability, and then on the tax return it shows a loss?
It's not as so. It's really interesting when you're for inventory based businesses. Most of them we match up and try to get accrual internal accrual tax. Okay. Really, accrual on financial versus cash internally is more prevalent, I think, from a tax planning standpoint when you're like a service provider, an agency, tech startup, things like that. Because you can't, like, just one quick thing. Basically, when you buy inventory, even if you pay cash for it, before 12/31, you still have to account for inventory in hand. You can't just like write it off on your tax return, basically. So like,
Yeah, because you're doing the physical counts, right? Versus
correct. You're doing
the
physical
cash
counts,
outflow. Yeah.
Otherwise, everybody would buy inventory by 12/31, and they're, the IRS, everybody have losses for tax purposes. So like, I think that the gain of being cash versus accrual and tax return versus internal like isn't as big on that aspect. But there is that exists, and that. But that's, we have a tax team in house, and that's where like I'd say go talk to our tax team. I don't even know, like there's so many nuances that come into play in it. But in terms of what Keith's saying is when you're doing that, trying to figure out and understanding, you may have specific reasons why doing cash basis works better for you to show profitability last year on your tax return. And then you tell the story from the accrual basis internal financial statements. Your profit and loss, by the way, or your forecast should be on accrual that then reconciles from your P&L to basically your cash balance is really what people would be looking for with that. So, and then I think a couple other things are, number one is inventory, as Keith said, like inventory detail. By that, you should, number one, inventory is your biggest resource of spend, right? As an inventory-based business, you should understand what raw materials you have, WIP, finished goods, etc. It doesn't always need to be completely reflected in the financials and the balance sheet. You could have one line item for inventory, but they say you have 250K in inventory here. How's that broken out? And if you spit out an inventory detail report, whether from an inventory system, whether from Excel, here's what I have in this product, this product, this is WIP, this is raw materials, this is this. Boom, that's a huge win.
Can I add something on that? Because finished goods inventory is what's financeable or can you be used as a basis of collateral. That being said, when you have specialty inventory lenders, the other categories, sometimes raw materials, sometimes goods in transit, can be financed against. But in the other settings, SBA, term loan lending, ABLs, etc., it's almost always only the finished goods. So having a good understanding of, just knowing the ranges, right? Because the timing effect can be huge, right? If you have, it's a funny thing, SBA and term loan lending measures one moment in time on that balance sheet, which of course is what a balance sheet does. So if your inventory is going to be massive and that can be leveraged for collateral value for something else, there's something to be said about the timing effect. Absolutely.
And then a couple other quick things of kind of specifics. If you have big dollar amounts for inventory prepays, let's say that you prepay 80 grand for inventory for whatever reason, having that properly accounted for as a payable plus an asset, i.e. prepaid inventory. Sometimes you don't properly account for it on your P&L when it's like, dude, that's coming in, that's an asset. You need to show that accordingly. Those types of things go into play specifically there. Another example is from just a pure kind of functionality standpoint, right? Let's say that you have a ton of, like, a quarter where you're spending a ton of promos out, samples out to various people, everything. And what you're doing is you're not properly accounting for them or kind of counting that information, those numbers. That could materially impact your margins because samples and promos should go to advertising bucket, not into COGS, right? So there's specific nuances like that once you get the fundamentals in a complete set of financials and accrual-based financials that then we dip and dive into as part of our onboarding, getting things in place to help facilitate. But I think at the core of it is complete financials, accrual base. From there, we can get into details of everything, and all that stuff is going to help facilitate literally what we're talking about here with Keith.
Can I ask you a super quick question expanding on that?
Absolutely.
I had a customer who's a distributor, and he had the opportunity, because of short supply of one particular large vendor, to buy 8 truckloads of this product in December. And he took it because the supply had been so erratic throughout 2022 that he decided to do it. So normally when you do that, right, if you're buying 8 truckloads, but you know that you're not going to sell it, it's a departure from normal course of business where you're buying 1 a week, right? How do you best account for that? When you buy, I think he put it all in COGS at once.
Yeah, the whole goal is you're matching the expenses when they're actually incurred. So a lot of times anything with COGS or any variable expense that's just tied to sales is really in that month were those products shipped out? Was the services related to sales incurred, freight, et cetera,
So
right?
he
Everything
sold
else
the
should go on the
one.
balance.
Yeah.
It should go on the balance sheet as like a prepay or like a prepaid expense, and then amortize it each month. If you don't have like a really good inventory tracking system in place going, currently, and you need to get a good set of month over month financials done from last year, an easy way to do that is to understand your average cost for all your SKUs that you're selling, right? Included in raw material, co-man, et cetera. And then going back and looking at your sales month over month, and then basically say, okay, for the entire year, I sold this much, and then make a mirror with your sales, right? So you kind of get some more consistent margins. So similar to what I'm saying, what you're saying here, he had this prepay, and then that's going to last over 6 months. Well, then take that divided by 6 or whatever compared to the volume is. So it just kind of gets more smooth financials. One of the things that people notice is, like me seeing financials as an accountant, I look at a financial statement, I look at huge, like, what are the outflows? What are the extremes, right?
Yeah,
Whoa,
sure.
negative, positive. Why is there a negative mark? Why is there a negative gross profit here? What's going on? So then I can tell within 5 minutes of looking at financials, this isn't right, this isn't complete. There has to be a reasoning behind this, right? So the whole goal is to have a very smooth month over month P&L balance sheet over the last 12 to 18 months looking backwards. And then that kind of sort of exudes confidence in just the underwriter originally. Like, look, this looks consistent. There's nothing crazy for me to, like, blow my eyes out or start asking questions on.
Yeah. The reason I quickly asked that is because he chose to put the full cash amount in COGS in December 22 to lower his tax liability, and it nearly crashed our deal because his profitability came in lower. So I had to negotiate with an underwriter and a business development officer for a couple of hours on a Saturday about how we keep the deal as structured, because when you blow something like that so bad, other than having going to restate it, we had to fight to get it added back and then show that he actually sold the product in 2023, because otherwise we would have had to make what's called a projections-based deal versus one based on historical profitability, and you have to re-underwrite everything. So that's a case of an extreme example of how you can mess things up with improper accounting.
Yeah, good. Oh, that's a great example and great information. So I think from here, I'm hopeful that kind of, from our chat last time of talking the types and the understanding, and even getting into some of the current economic climate of kind of some specific action steps to take currently, even on the intangible side, mindset, team, et cetera, getting ready for that. Think of, you getting married soon, and I'm going to buy a house in 18 to 24 months. It's the same process. It's getting your credit scores in place, understanding your cash, getting things built up. What do I need to do? What do I need to think about as part of it? Very similar process. If you ever went to buy a house just tomorrow because you're like, this house looks great, and then you go and you're not prepared, it's the same exact process where you just get your ass kicked. You're like, wait, what's going on? What do I need? I didn't know that. And it can be just a mess and a very frustrating and to be frank, very like belittling experience. So be proactive in it. And then outside of that, the specific, reporting or the requests, the tax returns, the credit reports, the personal information, the financials in place. And then lastly, just some specific kind of accounting and kind of financial reporting nuances and just understanding of it. But so I think that is a really good comprehensive couple podcasts here, Keith. Really appreciate your time. Any other last words?
Yeah, again, I would just say, I'll say it again, the proactive person really has the best chance of getting the best result, the fastest result, and the most variety of financing available to them. So we hope that, I certainly hope that this serves the Accountfully community in some way. And because we're all here to support you and help you grow the company of your dreams and get you the right financing at the right time. And Brad's supporting you on all that it takes to get you there as well.
Awesome. All right. Keith Kohler, thanks again. Your financing man, I guess financingman.com. Great new brand, and he's here to help and serve the community. He's got a big passion for this community, and I think he's just getting started. So put him in your Rolodex. Keith, thanks again. Really appreciate it. Have a good one. Episode 30 of the Month End Podcast. Hope you all enjoy it.